Hey, McCarthy and Cox family. My name is Jim Cox. I'm the managing partner of McCarthy and Cox, and we thought we would take this opportunity here today to reach out in a broader scale than what we've done maybe in the past, to help just address some concerns that folks are having right now with the market volatility specifically and the coronavirus and just all the things that we've had to deal with over the last couple of weeks. And the before we jump into the meat of the argument here, what I'd like to do first is just to, for my staff's sake, I am wearing dress pants. So, yep, it's okay for certain video bloggers to wear purple sweatpants, and maybe people will take your advice on what frozen pizza to get, but probably not professional advice. I think you should be wearing pants to give professional advice out. So, also, before we really jump in, I want to take this opportunity to make it very clear, because we deal in a very rules and regulation based industry. And so I want you to know that whatever we talk about here in these videos, specifically today, is not meant to be a recommendation in any way, shape, or form for any of our clients. It's not meant to be for you guys to take it that every single one of these strategies is already implemented in your guys' portfolios. If you want to talk specifics or anything else, please give your advisor a call, and they'd be happy to walk you through some of the various strategies that we've used in your situation to help alleviate or mitigate the financial downside of a market volatility that we've been seeing. So, it's a scary time, right? And we work primarily with people who are either really close to or in retirement. And so if you've worked your whole life and saved your whole life in order to get to the point where you're financially independent, and then you pull the trigger on that retirement, and something like the environment that we're seeing right now happens, it's easy to get very scared and to start making emotional decisions with your financials information and situation. And we just want to try to keep people from making those kinds of decisions, because ultimately the reason you hired us is to help you navigate through this retirement. And the good news is that you're in good hands. We've helped negotiate clients through, honestly, I used to say 2 of the 3 worst financial collapses in our nation's history, but we'll see if we're going to now be 3 for 4. Unfortunately, none of us were alive during the Great Depression. No, fortunately, we were not alive during the Great Depression. So, the good news is our plans hold up. Our financial plans hold up. Our strategies hold up. And now more than ever, we're very thankful that we have such a conservative investment philosophy and approach. So what I thought we'd do today is just kind of, instead of having one-on-one conversation, which we are, all the advisors are reaching out to all clients. If you haven't heard from your advisor yet, be on the lookout. They're probably going to reach out soon. But if you have any, pressing matters to discuss, you please give us a call. But I thought we'd go through just more in general some of the strategies that we've put in place to protect people and folks over the years. There's no way we can go through all of the different various risk mitigation strategies that are out there. If we were to do that, you'd tune out by the end of it. Well, and maybe some of you have already tuned out. But I thought I'd go through at least some of the more popular ones that we've integrated over the years, and then kind of go from there. Let's start like big picture and then work our way down for just a second. One of the biggest things that we've done for a lot of people is, again, a retirement income strategy. And we are always, changing things and adapting and adopting different ideas, adapting to, current times. A tried and true planning strategy for retirement income is the buckets approach. And I know a number of clients have that approach in their portfolios. And that's the use of 3 distinct buckets of money, if you will, where we take your retirement savings and we split it out. and we split it out into 3 different buckets. One bucket would be for usually anywhere from 3 to 5 years worth of your current income needs. And that's where we set up your systematic withdrawals for monthly income. So you live on a budget based on those withdrawals each month. And that money is sitting there in very safe investments. Short term, we're trying to get you a little bit of interest on those. They are not in the stock market. That money's not in the stock market. So, as far as, I know a number of people have asked, should I stop taking withdrawals from my retirement assets to just allow things time to recover? Well, if you're one of the individuals who have adopted this strategy, the answer is no, because you're really not selling any stocks in order to get your income. So, and that's the reason you do it. You have very safe money for a period of time, 3 to 5 years. Allow the markets to kind of come through their tumultuous time, and then reassess. Bucket number 2 is generally from 5 years to 15 years of income. Okay, so that's usually the bulk of the money. There's a lot of money in that middle bucket, and with that, we implement a diversified approach, like ones that you would see a little bit more typical on a Vanguard target retirement date fund, meaning and for Honda folks, you know what I'm talking about there. A diversified portfolio of stocks and bonds that's tailored and kind of a moderate allocation, if you will, so that you're not all in one thing, you're diversified. And then the third bucket is a 15-year plus bucket, and that's the growth bucket. That's kind of a little bit more aggressive. In tumultuous times like this, you're going to see that one move both positively and negatively very quickly. But the point of that is we don't need that money for 15 plus years. So it can be mostly in stocks with the idea that over that 15-year period of time, you'll make money. The reason we do 15 years is specifically historically, even the Great Depression, there was never been a 15-year period of time where the stock market has lost money. Okay, so that's by design, and that we've if we're going to be aggressive somewhere, let's be aggressive in the bucket that you don't need for a long time. So that's a common strategy for retirement income planning and designing getting income out of your retirement portfolio. The second one that we've implemented for a number of people is something called guaranteeing the core. And guaranteeing the core expenses is looking at your overall budget, your overall expenses, and making sure that whatever that core number is, whatever that amount of money that you need to pay the bills, to live that basic lifestyle, if you will, of retirement income that you want to see, and then putting that into something with guarantees. There's a lot of different options that exist as far as putting things that would have a guarantee. Obviously, the most commonly used investment option would be annuities. There's good things about that, and there's bad things about that. And so, again, this isn't a product recommendation in any way, shape, or form. I will say right now, things with guarantees, clients tend to sleep better at night when they know they have that guarantee there in place. And so it depends just how conservative you are and how aggressive you are, and which strategy makes sense in your own personal finances. So that's kind of 2 of the main common ways as far as retirement income strategies that we've used in the past to kind of help people with risk mitigation. As we go from big picture, like planning, down a little bit lower, now we start talking about the implementation of those plans, and specifically the investments and investment allocations. What you'll be, you've heard from day one with us and with any advisor that you might have had, or even just at your workplace retirement plans, you'll hear things like diversification. That is just the tried and true way of investing for the long haul here. Don't put all your eggs in one basket. Even after 2008 and 2009, I would have said there's no way people would fall for the whole try to be real aggressive mentality again. And for the most part, that's been true. I think people are more conservative today than they were back then. But we saw across the board, not necessarily with our clients, but with investors in general, just get way too aggressive, and they were putting all their money in the same kind of stocks, all growth stocks, which is great, and growth is awesome, and your Facebooks and Googles and Amazons and Teslas and things like that. When they were doing well, Tesla was doing amazingly well, right? So the problem with that for retirees is it's too volatile. You can't really build a retirement income plan around a whole bunch of high growth investments. They don't pay dividends, generally speaking. They don't pay dividends. So we kind of tend to lean on a little bit more dividend paying, larger companies, number one, that pay dividends, number two. And not to say that there's not growth stocks in our portfolios. Of course there is. You have to have them in the portfolio. But as far as an overweight type of situation, we generally do not, just simply because we're trying to get income from our retirement portfolios. And then you go from diversification, not just in the stock market, from large companies to small companies, from value to growth, but also on the bond side of things. You have U.S. governments, you have municipals, you have corporate bonds. So you want to diversify across all of that spectrum, as well as diversify across length of times. So short-term bonds generally are more conservative than long-term bonds, and that just makes sense. The interest rate environment has actually been going down right now, which means bonds have actually performed decently well. Now, some of your corporates and some of your what's called high-yield bonds that were lent, money that was lent to smaller companies, that in exchange for the risk that people were taking, they were getting a little bit more interest. I saw a lot of people that were trying to get more yield, more interest out of their portfolios, so they were going to smaller and smaller companies and smaller, to get high yield bonds. And the problem with that is high yield bonds generally act just like the stock market because of how risky they are. And so what I would say to that is, we again generally do not put a whole big overweight in those categories. We kind of worry about overall just the riskiness of the portfolio. And so, you want to make sure that you don't necessarily, you don't necessarily take too much risk with your portfolio, and diversify away some of that downside risk. A big risk management thing that we use at McCarthy & Cox is we still use, not primarily necessarily, but we definitely have a good chunk of money in active money management, which basically means, we have people who are, buying and selling and picking individual, let's say on the stock market itself, individual stocks. Even in this environment, once the fear's done, which it looks like at least right now, of course, you're watching this video a week from now, who knows? But for the last couple of days anyway, it seems like the fear of selling has diminished. But even in almost every market possible, Jim Cramer on CNBC will say there's always a bull market somewhere. Well, specifically, even in these choppy type of markets, you can find individual security stocks that might be doing well. This Zoom internet, right? Everyone's doing these online webinars now. So I know that was one of the stocks that did really well because of now a whole bunch of companies going into that. So it already did well. That's not a stock recommendation, by the way. It's just an example that I'm showing that even in bad market environments, there are ways to make money and things like that. And so having active management, having somebody that's picking what they believe will be the winners going forward, generally in choppy markets like that, generally will outperform just the average index fund, if you will. The other big thing that we do, which is very unique to McCarthy & Cox, and it all comes out and sprouts from the idea that we work with retirees. The other idea is we use structured products. We use investment vehicles that are structured to give you a certain outcome. And specifically on the stock market alternatives that we've used in a lot of portfolios, we have ones that have like a 15% downside protection. They call it a buffer note, which means, if the S&P 500 were to go down, 15%, you'd lose zero. over like a 2-year period of time, let's say, you'd lose 0. And if it lost 16%, you'd lose 1%. And every penny of loss beyond 15% you would lose, but you'd still save that 15%. And then the cost of the program, the cost of that is, because there's no such thing as a perfect investment. That's true across the board. Everybody knows that. Hopefully by now you know that. And hopefully our advisors are out there saying, the positives and negatives for every single thing. Because our job is to advise, not to sell anything. If there was a perfect investment, we'd all be in it all the time. It doesn't exist. So specifically on structured products, one of the downsides is it usually caps your upside. Can't make that much in them, maybe 15, 16. We've seen as much as 20-something% on the upside. But, for a retired client, a 20% upside, over a 2-year period of time, generally some of our clients are willing to, forego that upside potential for that downside mitigation that they get. Anyway, again, not a recommendation for people, just simply a discussion topic in general about the ideas of some of the investment strategies that we've already implemented in client portfolios so that you can have the courage to just enjoy your retirement. Don't, make emotional decisions with your money, and allow us to continue to help you through this process. We will get through it. Back in 08, 09, we were able to demonstrate significant value to our clients during that time. And so far in the last number of weeks here, once again, the strategy of being a conservative investment firm has paid off. So I'm going to leave it there. It's a little bit longer than I intended to talk, but that for my clients that have met with me, you're used to that. So God bless you guys. Thank you so much. If you need anything, if anyone's at home and needs anything at all, please give your advisor a call. We're starting a network of our staff in-house to try to make sure that everyone has whatever they need. And if you're stuck at home and you have a health condition that you really shouldn't go out and you just need some help, just give us a call and we'll go out there and get something and drop it off at your front doorstep or something if you're local, or ship it to you if you're not local. So again, thank you guys. God bless you. And if this was helpful, leave a comment for us to move forward. Maybe you can leave a comment on another different type of topic you'd like to maybe do one of these on, and I'll try to do something soon. Take care.